If you had invested just $200 a month since 2014, you'd have over $70,000 today. If you left that same money in savings, you'd have less than $25,000. That $45,000 difference could be the reason you retire rich or spend your golden years eating ramen noodles. Want to start investing but have no clue where to begin? Maybe you got burned by some scam and now you're scared to touch anything investment related? Look, nobody taught me how to invest either. I'm an architect by trade and I made every mistake you can imagine. But after years of studying what actually works, this isn't as complicated as everyone makes it seem. In just a few minutes, I'm going to show you a type of investment that beats 90% of professional money managers without you picking a single stock. But first, let's talk about the hidden enemy that's stealing your money right now, even while you sleep. The hidden enemy eating your money. Before we talk about making money, let's talk about how you're already losing it without even knowing. This enemy is called inflation. Here's what inflation actually means. Prices go up over time, so your money buys less stuff than it used to. Let me give you a real example. Say you get a $50,000 bonus at work today. You could buy a decent used car with that money right now. But if you stuff that $50,000 under your mattress for 10 years, that same $50,000 will buy you significantly less, maybe what costs $37,000 today. That's inflation in action. At roughly 3% per year, your purchasing power gets cut in half every 23 years. So while keeping your money in a savings account feels safe, you're actually guaranteed to lose money over time. The bank might give you 0.5% interest, while inflation eats away 3% of your buying power every year. You're losing 2.5% annually by playing it safe. But here's where it gets interesting, and this is going to blow your mind when you see the actual numbers. The most powerful force in the universe. Here's the concept that changed everything for me: compound interest. Compound interest is when your money makes money, and then that money makes money, and so on. Let me show you with actual numbers. Start with $1,000. Earn 10% in year 1, which is $1,100. Year 2, that $1,100 earns 10%, which is $1,210. Year 3, that $1,210 earns 10%, which is $1,331. Notice how the dollar amounts you're earning get bigger each year? That's compound interest working. But here's where it gets really crazy. Let me show you two people who made completely different choices. Jake starts investing at 22, invests $200 per month for 8 years, until age 30. Total invested, $19,200. Then stops contributing but lets it grow at 7% annually. At age 62, $602,000. Mike waits until 30 to start. Invests $200 per month for 32 years until age 62. Total invested, $76,800. 4 times more than Jake. Same 7% annual return. At age 62, $526,000. Jake invested way less money but ended up with more because he started earlier. Time is more powerful than money when it comes to investing. That's why Warren Buffett says, the best time to invest was 10 years ago. The second best time is today. And speaking of timing, let me show you something that most people get completely wrong about market crashes. Understanding market cycles. Here's something that never changes. Markets go up and down in cycles. When things are good, people get optimistic. When people get optimistic, they make stupid decisions, like borrowing too much money to buy stuff they can't afford. When things get bad, people panic and sell everything. This creates opportunities for smart investors who understand the cycle. The key insight: nothing falls forever, and nothing rises forever. After every storm comes calm, and after every calm comes another storm. The best investors use this to their advantage. When everyone else is panicking and selling, that's when you find the best deals. Think of it like buying a car during a recession. Suddenly that $50,000 truck is selling for $35,000 because everyone needs cash fast. What can you actually invest in? Alright, let's get practical. I'm going to break down 7 different types of investments, but here's the thing. One of these will let you own real estate with just $100 without ever talking to a tenant. And another one lets you invest in over 500 companies with a single purchase for less than the cost of a nice dinner. Let me rank these from lowest risk to highest risk. The boring but safe category. Number 1. Bonds and CDs. Lowest risk. When you buy a bond or CD, you're basically lending money to a bank, company, or government. They promise to pay you back with interest. What's the risk? Very low. What returns can you expect? Around 2 to 5% per year. Who should use this? Conservative investors and emergency funds. The real estate without the headaches category. Number 2, real estate investment trusts. REIT. Here's that $100 real estate investment I mentioned earlier. REITs let you invest in real estate without buying actual property. You own a slice of office buildings, apartments, warehouses, and shopping centers. Professional managers handle all the work, finding properties, dealing with tenants, maintenance, everything. You just collect dividends. What's the risk? Low to moderate. What returns can you expect? Around 4 to 8% annually plus potential appreciation. Who should use this? Anyone wanting to diversify beyond stocks and bonds? The own a piece of Apple category. Number 3. Individual stocks. When you buy stock, you own a tiny piece of that company. If the company does well, your stock goes up. If they pay dividends, you get cash. The problem? Picking individual winners is really hard, and you need a lot of money to diversify properly. What's the risk? Moderate to high. What returns can you expect? Historically, about 10% annually for the overall market. Who should use this? People who enjoy researching companies. Number 4. ETFs, exchange-traded funds. And here's that investment that beats 90% of professional money managers. ETFs are like buying a basket of stocks with one purchase. For example, the S&P 500 ETF gives you ownership in all 500 of the biggest US companies: Apple, Microsoft, Amazon, Google, Tesla, all in one purchase. Instead of needing $100,000 plus to buy shares of every company individually, you can get exposure to all of them for less than $100. What's the risk? Moderate, because you're diversified. What returns can you expect? Depends on what the ETF tracks. Who should use this? Almost everyone, especially beginners. Now let me show you the more advanced stuff. But be warned, this is where things get risky. The high risk, high reward category. Number 5, private equity and private real estate. These are investments in companies or properties that don't trade on public markets, usually requires larger minimum investments, $25,000 plus, and longer time commitments. What's the risk? Moderate to high. What returns can you expect? Potentially higher than public markets. Who should use this? Experienced investors with larger accounts. Number 6, cryptocurrency. Crypto is digital money that's not controlled by any government or bank. Based on blockchain technology, Bitcoin, Ethereum, and others have created massive wealth for early adopters, but they're extremely volatile. What's the risk? Very high. What returns can you expect? Unpredictable. Could be plus 500% or minus 80% in a year. Who should use this? Risk-tolerant investors with small allocations. Number 7. Startup investments. Highest risk. Investing directly in early-stage companies. Most startups fail, but the ones that succeed can return 10x, 100x, or more. What's the risk? Extremely high. What returns can you expect? Either massive gains or total losses. Who should use this? Wealthy investors who can afford to lose the money. Alright, so now you know what you can invest in. But here's the question everyone has in mind. How do I actually start? Let me show you exactly how to do this. How to actually start. Now, for the practical stuff. Here are some platforms where you can start investing. For US stocks and ETF, you can use Fidelity, Vanguard, or Charles Schwab if you want traditional brokers. If you prefer app-based platforms that are good for beginners, try Robinhood or Webull. And if you want automated investing, M1 Finance is great for that. For real estate, you can buy REITs through any stockbroker. For private real estate, check out Fundrise or Yield Street. For crypto, the most beginner-friendly options are Coinbase and Kraken. If you want to start super simple, you can even use Cash App or PayPal. How much to start with? You can literally start with $1 thanks to fractional shares. But realistically, $100 to $500 gives you enough to build a simple, diversified portfolio. My recommended beginner strategy. If I were starting over today with limited money and knowledge, here's exactly what I'd do. Open a Roth IRA, tax-free growth. Buy a total stock market ETF like VTI or SWTSX. Invest the same amount every month regardless of market conditions. Don't check it obsessively, maybe once per quarter. Increase contributions whenever you get a raise. This simple strategy beats about 90% of professional money managers over 15+ year periods. The following reasons are why this works. You're diversified across thousands of companies. Low fees, under 0.1% annually. No need to pick winners and losers. Automatic compound growth. You can start with almost any amount. The biggest mistakes to avoid. Waiting for the perfect time, there isn't one. Trying to time the market, you'll probably fail. Picking individual stocks before understanding basics. Checking your account daily, you'll drive yourself crazy. Selling during market crashes, that's when you should buy more. Following hot tips from social media or friends. The bottom line. Look, investing isn't about getting rich quick. It's about not being poor when you're old. Every month you wait is costing you thousands in future wealth. The magic of compound interest only works if you give it time. Start small if you have to. Start simple if you're confused, but start. Every day you delay is money you'll never get back. Your future self is counting on the decisions you make right now.